some of the research that I've read that you've been involved with basically also shows that banks with very large deposit bases tend to inherently take more risk. In other words, they might price loans at cheaper rates in order to get more business because they have a feeling that they've got a large deposit base that makes them safe. But in turn, they feel also as though they aren't going to be the subject of a run. Is that the sort of, if you like, psychology of banking in some ways?
So where deposit insurance or depositor protection exists, then there is usually up to a certain amount of threshold of deposits that are going to be protected. In the US, it's the FDIC that takes on that role, guaranteeing up to $250,000 US of depositors' funds there. That is necessary. That sort of regulatory protection is necessary because, based on the Nobel Prize winning work of Diamond and Dybvig that was recognised last year, the vulnerability with the traditional banking model, with the maturity transformation that they are, engaged in with their unique role in a financial system, is that there are likely to be runs and trust evaporates very quickly within financial systems, and we've seen that happen, over and over again, over time and throughout history. So then it's important to have this base level of protection in place to ensure that depositors feel sufficiently safe with parking their funds with banks so that they are able to engage in this important function that they engage in this maturity transformation and extend the credit throughout the economy.
Okay, but then is there another danger, and that is we saw in this past week when the Federal Deposit Insurance Corporation and the Federal Reserve came out and said it would guarantee all of the deposits in Silicon Valley Bank and presumably Signature Bank as well. Is that an equal danger if you guarantee all of the deposits?
Yes, it could be too much of a good thing. So one of the concerns that economists have is with this issue of moral hazard. So if there is this expectation that the protection will be there at all costs and whatever it takes at the taxpayer's expense, then there is going to be this encouragement of risk-taking, as you suggest, throughout the banking system.
So, therefore, Australia, bring it back home here, we also have a guarantee on $250,000 invested or deposited in any financial deposit taking institution. Here is quite different because it seems the oversight of APRA, the financial system inquiry that we've had, means that the regulation over the banks is much stricter here than it was in the United States especially.
That's right. In 2014, we had the financial system inquiry, if you recall, Ross, and one of the key recommendations coming out of that was to ensure that our banks would be unquestionably strong, being in the top quartile of all banks in the world. And to ensure that we got there, the regulators, in particular APRA, recommended that banks held larger capital buffers, and they increased the capital requirements to at least 10.5%. And the idea with doing that is to ensure that banks were fundamentally strong to weather any economic shocks that might come, in the system. If you recall, it was particularly the 2007 through to 9 GFC that was front of mind, at that time, and ensuring that our system would become more resilient to these sort of shocks that would come, globally. We're seeing it now. I mean, with the rapid interest rate hikes that are, being implemented all around the world, the financial systems are weathering, these unprecedented, moves. And our earlier work based on historical data in the Australian banking system revealed that really you don't need to increase capital buffers by that much in order to have huge benefits on reducing system-wide losses throughout the banking sector. I think there's merit in requiring banks to have the higher minimum regulatory capital requirements for the huge benefits that it can bring to the entire financial system and the aggregate economy.
Professor Eliza Wu, Head of Discipline at Finance at the University of Sydney Business School. Many thanks for your time on the program today.
Thank you, Ross. Great pleasure to join you.